Hi friends, my name is Nilesh Phadke, your learning partner in finance and accounts. In this video, we will learn mainly about the preparation of the profit and loss account and balance sheet and the associated journal entries. Whenever businessman starts any business, he makes sales, incur expense, and at the end have some profits from the business. This is basically recorded in profit and loss account of the statement. At the same time, he takes bank loan for the business, make investment in FDs or other assets, also buy some computer and equipment, plant and machinery for the business. All these transactions are recorded in the books of accounts in the form of journal entries. So let's understand how to file journal entries and prepare profit and loss account and balance sheet with an example. So here we go. Rent expense during the year is rupees 25,000, out of which 5,000 is paid from bank balance of the company and 20,000 is still payable. So rent expenses during the year 25,000 is recorded in profit and loss account. So rent expense here as 25,000. So total expense is 25,000. So profit, that is A minus B, is minus 25,000. Opening profit is 0, so retained earning is minus 25,000, which will appear on the balance sheet liability side as minus 25,000. Out of which bank balance has reduced to the extent of 5,000, as 5,000 is paid from bank balance, so minus 5,000 here. And balance 20,000 is still not yet paid, so it will appear on the balance sheet liability side as rent payable, rupees 20,000. So total liability minus 5,000, total assets minus 5,000, and your balance sheet tallies. Journal entry is rent account will be debited based on the rule of liability reduces debit, 25,000. So here retained earning, that is balance sheet liability side, is reducing by rupees 25,000. So rule is LRD, that is liability reduces debit, and hence retained earnings account will be debited. However, whenever retained earning is appearing in the balance sheet journal entry, you do not directly write the word retained earning. Rather, you write a transaction which is affecting this retained earning. There is rent in this case, and hence rent account will be debited by rupees 25,000. At the same time, your bank balance is reducing by rupees 5,000. So rule is assets reduces credit, that is ARC. So bank balance will be credited based on the rule of ARC, that is assets reduces credit, rupees 5,000. At the same time, on balance sheet liability side, rent payable is increasing. So rule is LIC, that is liability increases credit. So rent payable will be credited for rupees 20,000. Narration is being rent expenses rupees 25,000. Thus we have passed necessary journal entry. Interest accrued on investment in fixed deposit rupees 10,000. Now interest on investment appears in income side in profit and loss account as 10,000. So total income is 10,000. There is no expense. That means profit is 10,000. There is no opening profit as it is a first year of operation. So retained earning is C plus D 10,000. Now this retained earning appears on balance sheet liability side as 10,000. So total liability is rupees 10,000. Now investment in fixed deposit will increase to the extent of 10,000 on account of accrual of interest. So on balance sheet asset side, investment in fixed deposit will increase by rupees 10,000 due to interest on investment accrual. So total liability is 10,000, total assets is also 10,000, and your balance sheet tallies. Now investment here is increasing. So investment account debit, that is assets increases debit based on rule of AID, that is assets increases debit rupees 10,000. On balance sheet liability side, retained earning is increasing by rupees 10,000. So retained earning will be credited based on the rule of LIC, that is liability increases credit rupees 10,000. However, whenever retained earning is affected in any transaction, you do not write the word retained earning in journal entry. Rather, you write the word a transaction which is affecting this retained earning, that is interest on investment. So LIC, liability increases credit rupees 10,000. being interest accrued on investments in fixed deposits. Depreciation created on plant and machinery rupees 20,000. Now depreciation appears in profit and loss account under the heading of expenses. So total expense is 20,000, thus the profit is minus 20,000 and retained earning is minus 22,000. Now this retained earning appears on the balance sheet liability side as minus 22,000. So total liability is minus 22,000. Plant and machinery on the balance sheet asset side is reducing to the extent of depreciation, rupees 22,000. Depreciation is basically wear and tear in property due to its use. So value of plant and machinery is reducing by rupees 22,000 on account of depreciation. So total assets is minus 22,000 and total liabilities is also minus 22,000 and your balance sheet tallies. Journal entry is basically retained earning will be debited based on the rule of liability reduces debit 22,000. However, whenever retained earning is affected, you do not directly write the word retained earning, rather you write a transaction which is affecting the retained earning, that is depreciation in this case. So depreciation account will be debited rupees 22,000. At the same time, plant and machinery is reducing by rupees 22,000. So rule is assets reduces credit, that is ARC. So plant and machinery account will be credited based on the rule of ARC, that is assets reduces credit rupees 22,000. Narration is being depreciation created on plant and machinery. Cash sales of first year is rupees 20,000 and second year is rupees 25,000. Now sales appears in profit and loss account. So in first year it is 20,000. So total income is 20,000. There is no expense. So total expense is 0. So profit, that is A minus B, is 20,000. Since this is the first year of operation, opening profit is 0 and retained earning, that is C plus D, is also 20,000. Now this 20,000 appears on the balance sheet liability side under the heading retained earning. So total liability side is 20,000. Now due to cash sales, cash balance of the company increases by rupees 20,000, which appears on the balance sheet asset side. So total assets is 20,000. So total liabilities is 20,000, total assets is 20,000, and thus our balance sheet tallies. Second year sale is 25,000. So total income is 25,000. There is no expense. So profit A minus B of the second year is also 25,000. Now opening profit, that is profit of the first year, we will write here. You can carry this 20,000 here. And thus retained earning, that is accumulated profit since start of the business, that is year 1 plus year 2, is 45,000. Now this 45,000 appears on balance sheet liability side under the heading retained earning. So total liability side of second year is 45,000. Now cash balance is also 45,000. This is because opening cash balance of 20,000 plus 25,000 is second year cash sales. So our cash balance at the end of year 2 is 20,000 plus 25,000 is 45,000. So total assets of year 2 is 45,000 and thus our balance sheet tallies. Now accumulated retained earnings since start of the business for year 2 is rupees 45,000, that is 20,000 plus 25,000. And accumulated cash balance since start of the business for year 2 is rupees 45,000, that is 20,000 plus 25,000. Now let us pass necessary journal entries. So cash account is increasing in the year 1 as 20,000. So based on the rule of AID, that is AID, that is assets increases debit, cash account will be debited by rupees 20,000. Retained earning on balance sheet liability side is also increasing by rupees 20,000. So retained earning will be credited by rupees 20,000. However, whenever retained earning is affected, you will write the word sales here, because sales is a transaction due to which retained earning is increasing. So LIC, so liability increases credit rupees 20,000. For year 2, cash is 25,000. Cash balance is increasing by rupees 25,000 due to cash sales. So it will be debited, and retained earning will be credited by rupees 25,000. However, you will not write the word retain earning while passing journal entry, but you will write the word sales here. So being cash sales made by the company rupees 20,000 for year 1 and rupees 25,000 for year 2.
Thus, to conclude, what we can say is that as a first step, you have to identify whether the item appears in profit and loss account or balance sheet. Once you identified this, based on the rule of AID, ARC, LIC, LRD, you can pass any type of journal entry. So first rule is AID, that is assets increases debit. Second rule is ARC, that is assets reduces credit. Third rule is LIC, that is liability increases credit. And fourth rule is LRD, that is liability reduces debit.